Ladies and gentlemen, dear IFA friends, I can assure you that Rotterdam at this moment looks a little bit like the picture that you saw at the intro of this seminar. Sun is shining, bright light. Good morning, good afternoon, good evening, maybe good night, and welcome to all of you in the virtual room of the IFA EU seminar. Now, before giving the screen to Robert Darnaud, chair of the PSC, who will introduce the topic shortly to you, I want to inform you on the poster sessions that can be accessed after this session, immediately after the session, from 5 p.m. till 5:30 p.m. Central European time it is. Wishing you an interesting IFA EU seminar, I herewith give the screen to Robert Darnaud.
Yes, dear IFA friends around the globe, as Hans said, good afternoon, good morning, or good evening. It's a pleasure to welcome you again today. Of course, we are entering into what is traditionally the signature conferences of IFA during the next 2 days, namely today, IFA EU and IFA OECD tomorrow, taking stock of the latest development that influences, in the case of IFA EU, not only developments within the internal market, but also beyond the internal market in third countries. This is why, as you will see, the panel reflects this interest for European developments, with members, of course, outside also the European Union. I'm delighted for this session to welcome Professor Luc Debreu, who is a professor of international and European tax law at the University of Leuven in Belgium. He is the chair of the IFA EU seminar. He has been also the chair in past editions of the IFA Congress. As you will see, we have a very heavy and fascinating agenda this afternoon. So I will turn immediately to Luc for an introduction of the panel and perhaps the sequence of events of the session. And with that, I wish you all a very interesting session this afternoon. Thank you very much.
Thank you very much, Robert. Hello, everybody. Wherever you are, good morning, good afternoon, good night. Welcome to the virtual seminar on EU taxation. Let me introduce the members of the panel to you. We have Mr. Benjamin Angel. He's representing the Commission in our panel. Benjamin joined the Commission in 1994 and has since then combined posts in the cabinet of different commissioners for economic and monetary affairs. He's currently Director for Direct Taxation, Tax Coordination, Economic Analysis and Evaluation, and Acting Director for Indirect Taxation and Tax Administration. From Germany, we have Johanna Hay on our panel. She's Director of the Institute for Tax Law at the University of Köln and Scientific Director of the Institute of Finance and Taxes in Berlin. She's also a member of the Scientific Advisory Board of the Federal Ministry of Finance in Germany. Robert already explained why we have Bob Stack in our panel. Bob is Managing Director in Deloitte's Washington International Tax Practice. Until January 2017, he was the Deputy Assistant Secretary for International Tax Affairs in the Office of Tax Policy at the US Treasury, and Bob was the official representative of the Obama administration for international tax policy and representing the US government at the OECD, where he was involved in all aspects of the BEPS work. And we have Rita Sudochki from Austria. She is assistant professor at the Vienna University of Economic and Business, where she is currently working on obtaining her habilitation. The secretary to our panel is Jasper Corvin. He's working with the University of Maastricht and the Lloyd in the Netherlands. Next slide, please. A few practical things. We have a 2-hour presentation, and I will in a second give you the details of the presentation, but a few practical things. We take a Q&A at the end of our session. During the last 10 minutes, we will try to answer your questions. If you would like to raise a question to the panel, please use the Q&A button on your screen, and please identify the panel member to whom you wish to address your question. We are not sure that we will be able to answer all of your questions, but we will do an attempt to at least answer some. And we have, during the presentation, polling questions, which will be put up the screen at certain points in time. At the end of the second part of the presentation on state aid and rulings, there will be 2 questions addressed to the audience, and within the third part of the presentation on the digitalized economy, we will have midway a polling question and also at the end of the presentation. Next slide, please. Our presentation of today is composed of 3 parts. As we did last year, we have invited the DG Taxud Commission to be present in our panel to set out the tax policy developments, recent developments from the past, and looking forward to the future. That will, of course, be handled by Benjamin Angel. That part will take us for about 25 minutes. And then we move to the second part, which is on the discussion of the recent case law on state aid and tax rulings. There, Mr. Angel will not participate in the discussion because he is a member of the Directorate General on Taxud. He is not a member of the Directorate General on Competition, which handles these state aid cases. And you understand that the Commission's policy is not to comment on pending cases. After that discussion on state aid, we will move to the last part of our presentation, which deals with the EU direct tax aspects of the digitalized economy. And as I said, we end with a Q&A. And I think we can go to the next slide and give the screen, I should say, to Benjamin Angel.
Thank you very much, Luc, and thanks a lot for IFA for your kind invitation. It's a pleasure to be with you this afternoon. Can we kindly move to the next slide, please? So I will try to introduce you a few things today. I will start with the package which was adopted by the Commission in July this year. This package was a rather large package with 3 key components. First one is an action plan for fair and simple taxation, and I will flag a bit the main elements in a couple of seconds. The second one is the now almost annual revision of the Directive on Administrative Cooperation. And the third one is a communication on tax good governance in the EU and beyond. Next slide, please. The action plan for fair and simple taxation is covering a rather wide spectrum of topics, with the exception of business taxation, that is a standalone, as I will explain you in a couple of minutes. The bulk of the initiative contained in the tax action plan are to be found in the area of indirect taxation. We have notably a number of initiatives in the field of VAT. For instance, we announced a program of initiative for reforming the VAT applicable to the financial services, to passenger transport, to travel agent. We also are preparing a big package for establishing a more digital-friendly system in Europe. and for introducing, and this is a very important change, single registration, whereby with one registration in one member state, you could operate in all EU member states without having to multiply the number of registration in your activity. There are also a number of initiatives related to direct taxation. I would mention two of them. We intend to launch a discussion with member states with a view to harmonizing tax residency rules. Today, the vast majority of member states use an approach whereby they look at the number of days spent in a given member state. Some pay more attention to the country where the person gets a majority of its income. We need to come up to some kind of common decision, common approach with a view to limiting the number of cases where you have citizens meeting simultaneously the tax residency of several member states, which is an extreme source of confusion, not only for them, but also for the tax administration. We're also drawing the first lesson from the interesting experience developed in the OECD related to cooperative compliance. We are taking steps to prepare an EU cooperative compliance program, and that would apply not only to multinational, but also to SMEs. And that is a particularity since the OECD action is just intended towards MNE. We also started discussing with member states ways to facilitate the implementation of tax relief via a withholding system. As you know, the implementation of the TRACE OECD system has been relatively limited so far in the European Union, and we have a number of countries where sometimes we are informed that the refund of tax relief takes ages. So we want to speed it up. The best way to do it is via a withholding approach, but that will obviously take some further discussion with member states because it calls for a big role for the financial intermediary, which is not always very natural to some of our member states. Next slide. The second big block is the seventh revision of the Directive on Administrative Cooperation. This big block has itself two components. One is a bit of housekeeping. We have done last year an evaluation of the Directive on Administrative Cooperation, which has highlighted a number of flaws that need to be addressed. We needed notably to clarify the definition of foreseeable relevance, to clarify the rules that apply to joint audit, to group requests, but also to address the issue of data protection, since we have experienced in the past situation where one member state has communicated significant issue at the occasion of the exchange of tax information. And while the OECD system does foresee the possibility to interrupt the transmission of the data in a certain context, the EU rules did not foresee such a possibility, which created a rather uncomfortable situation a couple of years ago, not only from the member states receiving the data, but also for those sending the data, which were at risk somehow of sending data which would not be properly protected. Next slide, please. But the biggest block of DAC 7 is related to digital platform. The primary target of DAC 7 is making sure that the EU tax administration get information from the digital platform on the activity of the sellers. And our proposal is broader than what is under discussion under the OECD. As you know, the OECD is discussing only services. The Commission has made a proposal covering both goods and services, and proposals that apply not only to platforms which are active in the European Union, but also and located in the European Union, but also to platforms which are active in the European Union and not located in the European Union. So it does create a system where foreign platforms have to register in one member state of the European Union. That member state will receive information from the platform and redispatch it to all the other member states having to receive the information. We have made the proposal in July, and I am pleased to inform you that since last Friday, the discussion have stopped since we have reached already a consensus between member states. So DAC 7 will be formally adopted in January. The small delay is due to the fact that you need a physical meeting for having it adopted. We cannot adopt text via video conferences, unfortunately. But the text, the discussion of the text has stopped, and we will already start working on the next step, actually, which is DAC 8, which will cover crypto assets and harmonized sanction. Next slide, please. The third component of our July package is a very important one as well. It's a communication on tax good governance in the EU and beyond. It has both an internal and an external dimension, and both of them are structured around the same group, which is a code of conduct on business taxation. The Code of Conduct is a group which has been established in 1997, so a very long time ago, whose mandate had never been revised since then. Initially, the mandate of the group was to tackle cases of distortive effect coming from preferential tax regime. That is, a regime where you offer better condition to foreigners than those you offer to your own fellow citizens or companies. Well, companies there, because it's business taxation. We have come to the conclusion that we're reaching a bit the limit of what can be achieved with the current mandate. The code has been extremely effective in addressing and preventing distortive measures which are constructed in a preferential way, but it is also our experience that some member states have built with time distortive regime which are not preferential in their construction. For this reason, we have proposed to extend the scope of the code to the general aspect of the tax regime, as long, obviously, as they produce some kind of distortive effect on the location of businesses in the European Union. Discussion is still ongoing within the Code of Conduct. It's a complex discussion, as you can imagine. It's a difficult one, but it's a very important one if we want to give a new impetus to the work of this group. The group has an internal dimension, but it has also, since 2017, an external dimension, because the same group is the one in charge of preparing the EU list of non-cooperative jurisdiction. As you know, we have a listing process with a rendezvous twice a year, in February and October, and we discuss the tax situation of a number of third countries on the basis of a set of criteria. When some criteria are not met, we put country on the Annex 2, and they have a certain period of time to do the right thing, filling which are put on Annex 1, which is a so-called blacklist, which does trigger rather extensive effect on countries concerned, not only reputational, but also practical. This list has functioned very well, I must say. So far, we have screened close to 100 countries, and we have obtained via the discussion process attached to the list with the countries concerned, changes of 120 tax legislation in more than 60 countries. The primary target of the European Union is not to export unilaterally in a brutal way its rule. It's rather to incentivize via the discussion process third country to join good tax good governance principle. So via this process, we have a very positive interaction with the OECD, since countries, for instance, to give one example, are asked to subscribe to the Multilateral Convention on the Exchange of Information. And because of this condition, among many others, the number of countries having subscribed to the International Convention on the Automatic Exchange of Information has moved from a little bit less than 50 to around 100 within the 3 years that we have been operating. We are discussing in this communication new steps and the introduction of new criteria, such as more aggressive criteria on economic substance, criteria on foreign source income exemption, and other elements of this kind, with a view to beefing up progressively the scope of our analysis. Obviously, we are aware that a number of third countries are struggling sometimes with the need to secure the necessary resources to have well-running tax administration. So the European Union is also ready to step up its effort to support third country tax administration so as to make sure that they can deliver on the commitment that they are taking. Next slide, please. Last but not least, well, not last yet, almost last, but not there yet. Business taxation. It's a standalone. We have faced a certain moving target situation, which was not due to our own bad will, but rather to the fact that a significant component of what we intend to say is linked to the ongoing negotiation in the OECD for Pillar 1 and Pillar 2. So initially, this communication was planned for July, and then for the autumn. Now it's postponed to the first quarter of next year. We will do communications that will flag the way we intend to implement an expected OECD agreement on Pillar 1 and Pillar 2, but we will also announce new initiatives, notably in two fields. One on which we have done a lot already, but on which more needs to be done, which is tax transparency. So we will announce a couple of new legislation in this field, including ENATAD 3. And we will also make some proposals which are more linked to the current difficult economic situation that most countries in the world are facing, and which should help member states supporting investment and growth. I ask for a bit of patience. We will unveil all this somewhere probably in February or March. Next slide. A very big priority for us is also the Green Deal. Actually, it was the biggest priority of the Commission when it started, and the COVID then has a bit reshifted the priorities, but as part of the Green Deal and the Fit for 55 initiative, there are three big texts which are coming up. Two are particularly important. The first one is a review of the Energy Tax Directive. It's a review which is foreseen in the directive itself. The current directive is extremely outdated. The floors that it set for the energy prices, for the taxation of the energy with a view to influence the prices, are completely off track with the evolution of the market, which is unavoidable for a directive which is that old. So we plan to do a very comprehensive review that will propose also a new methodology, and that will take better account of the need to favor clean sources of energy with a view to facilitate the transition towards a greener and cleaner economy. The impact assessment is ongoing. We will make proposal in June. At the same time, we will make also proposal for a very important component, which is the carbon border adjustment mechanism. The idea of having something in this field has been floating for a very long time. The primary goal is not protectionist. The primary goal is to incentivize third country to do the right thing. That is to take measures aiming at reducing their carbon consumption when producing. The main way to ensure such an incentive will be to ask importers of foreign of foreign products in some sector to pay a certain amount, which will reflect the cost of carbon, and a cost of carbon which is equivalent to the one that would be charged for a similar product in the European Union. The public consultation has now ended. We are in the process of assessing it. There is also an impact assessment which is ongoing around the number of options. We are looking at a large spectrum of options, but I must say that at the moment there is more attention to some of them. A possibility could be a border tax. Another possibility could be to have some kind of notional ETS, whereby importers would buy allowances which are not tradable in the main ETS, but which come with a cost which is comparable to the one that European producer face. And in all cases, there would be nothing to pay if the producer concerned does better than the EU benchmark, or if the country concerned from where the producer is located has rules which are equivalent to ours. So again, the intention is not to be protectionist. The intention is to have a built-in incentive to have solid rules for reducing carbon consumption in all the countries in the world with which we are trading. And the third important element related to the EU Green Deal, but on which the work is far less advanced because the work is far more backloaded, is the amendment of the VAT directive on passenger transport. Next slide. Some of the elements I mentioned have a double dimension. That is, there are to take the form of a new tax legislation, but a tax legislation which will have a connection to another purpose, which is financing the union budget. The heads of state and government and the European Parliament have flagged very clearly that we should raise own resources to repay the debts that will be taken under EU Next Generation, which, as you know, is a 750 billion euro package that comes on top of the normal multi-annual financial framework. This will be done via a couple of new own resources. The main one will be the European Trading Scheme, but the carbon border adjustment mechanisms will be a very important one, combined to the ETS. Because the carbon border adjustment mechanisms imply by its very creation that we question the free allowances under the ETS. Since the rationale for the free allowances was to limit the risk of carbon leakage, if we introduce a carbon border adjustment mechanism, this is addressed. And by doing so, we will increase very substantially the income coming from the ETS. The second one is a digital levy. It has been decided that it should be also one of our own resources. I will not enter into it now because we will have a dedicated discussion on digital a bit later. And I will stop my presentation there. Thank you.
Thank you, Benjamin. I would like to make an observation on the list of non-cooperative jurisdictions. I understand this is not a list of tax havens. It's a list of low tax jurisdictions that do not comply with the OECD standards on exchange of information or BEPS minimum standards, and that at the same time do not commit themselves towards the EU that they will comply with those standards in the future. That is what you call do the right thing. As a result thereof, this list is by all means a very short list. There are only 12 jurisdictions figuring on these lists, and jurisdictions like American Samoa, Guam, or Vanuatu are not necessarily important trading partners to the European Union, and thus a bit irrelevant. And member states, in practice, what you see is that member states do not apply the EU list. For instance, to take an example from my own country, Belgium, we recently adopted several tax concessions under our COVID-19 recovery plan, but we decided to carve out from those tax concessions any corporations that control companies in tax havens or make payment to companies in tax havens. And the legislator decided not to use the EU list because public opinion and the members of parliament that do represent the public do not understand why Cayman Islands, British Virgin Islands, Bahamas, just to name a few, are not included in the EU list. Lawmakers in the area of corporate taxation are not so much concerned whether a jurisdiction is not exchanging information or not complying with the BEPS minimum standards, but they are very much concerned that their domestic corporations do not shift profit to tax havens. And that's why they use own lists that include states that levy taxes at general rates below a certain percentage, such as 10 or 15%. And in my opinion, the EU, the Commission, should recalibrate the scope of the list and make sure in the first place that they have in scope all tax havens. Non-transparency and failing to meet BEPS standards is, in my opinion, only of a secondary importance. If not, I think if such a recalibration does not take place, I am afraid that there will not be support from member states for legislative actions if the Commission would take legislative actions for coordinated defensive measures under that list. And I think Johanna Hay also wants to make an observation.
Thank you, Luc. Well, I think this is a really very impressive agenda for the Commission in the realm of tax law. And it's, on the one hand, broadening and also deepening the agenda. Luc already had some observations on the list, which is one of the important tasks of the Code of Conduct Group. I myself, I have some open questions regarding the considered reform of the governance structures of the Code of Conduct. As Benjamin mentioned, the Code of Conduct Group worked very well for the last more than 20 years. The Code of Conduct played an important role as a soft law instrument. And it operated on the basis of peer review and peer pressure between member states. And it was somehow quite effective in pushing member states to undertake reforms. So what appears to me is that the considered reform of governance structures would upgrade the Code of Conduct Group's competences quite significantly. So on the one hand, the communication of July 2020 considers qualified majority voting within the Code of Conduct Group, with the aim, very understandable, to speed up decision making. However, this would be a real novelty in the realm of tax law, where the TFEU requires always unanimity. And at the same time, the Commission also discusses the option of effective consequences for member states that do not comply with the group's decisions on time, so effective consequences. I mean, all of this also broadening maybe the scope on what the group is working makes a lot of sense in order to broaden from this preferential regimes to broaden the work of the group against tax competition in general. However, I have problems whether soft law can be tied with effective consequences against member states, or, as it's also said, with an obligation of the member states or for the member states to apply sanctions vis-a-vis third countries. So in my view, here the Code of Conduct Group would cross the bridge to harmonization, and obligations for the member states, they need to be decided in the regular legislative process. And we also, and Luc already addressed that a bit, we also need to discuss how the group's actions are aligned with actions already undertaken. I mean, this last point, the Code of Conduct Group seems to be aware of. In the November 2019 report to the Council, the question was raised how the group's work on defense measures would relate to the ATAD, because they also have defense measures. So I do think that Probably the work of the group is very important, but as I said, it raises some open questions on its position in the whole process. Thanks a lot.
Thank you, Johanna. Benjamin, you want to respond?
Absolutely. Thanks, Hugh and Johanna for your remark. I'll start with yours, Luc. It is true that at the moment, the main focus is on tax transparency. And there are many tax experts listening to us today, and I'm sure that many of them understand also the value of transparency. When you get far more information on what is happening, you also produce a deterrent effect on bad behavior because you can detect them more easily. The very fact that we have obtained a significant increase of the automatic exchange of information those last years has translated into a very blunt reduction of the volume of deposits in tax haven. And that is directly connected to the transparency effort of the OECD and of the European Union. Now, as regards the interconnection between the EU list and member state, this is undoubtedly a difficult issue and one which is not fully satisfactory yet. Some member states have a national list, some don't. And today we face a situation where there is no full consistency between the EU list and the national list. And while somehow intellectually I don't mind that member states decide whatever they want for countries which have not been screened at EU level, it is difficult when you talk to a third country, ask the third country to do significant legislative changes, which for some of them may be politically extremely sensitive, because very often those legislation are here for a domestic reason. And then you delist the country, you tap on the shoulder, you say good work, and the country realizes that it's still blacklisted by a number of member states. That is very difficult to explain. So we intend to tackle this discrepancy via an iterative approach. The first thing that we will do is enter into a discussion process with member states on why is it that a country is blacklisted domestically, which is not blacklisted at the EU level. That is, what criteria do they use? We have already started this discussion. We have already started this monitoring. And from the first element that we get, the most frequent source of difference is that member states pay more attention to the effectiveness of the implementation of the commitment, not only on the country taking the commitment. So the first thing we want to do is import the good experience at national level into the EU listing process by beefing up our criteria. And effectiveness will be on the menu. Actually, this year, we already have one precedent where for one third country, the code has come up with a request of not only committing, but also effectively delivering on the exchange of information. So we will do it more systematically. But once we have done this, we should endeavor to have an alignment for all countries screened between EU and national list. This begs also the question of the consequence of the list, the defensive measures. We are a few weeks before a very important rendezvous because the member states committed, all of them, to introduce as of the 1st of January, defensive measure against jurisdictions which are blacklisted on the EU list, all of them. It's a menu, so it's not a one size fits all. But today, we already have some member states that go very far. Let me give you the example of the state I know best. In France, if a country is blacklisted at EU level because of economic substance problem, there is a withholding tax on all transfers towards that country of 75%. 75% level, which I guess is relatively deterrent. So we need to discuss further defensive measure. It's a question of credibility. We have done already, as far as the Commission is concerned, our share of the work. We have introduced in the financial regulation a couple of years ago measures that prevent the use of the guarantees of the union budget to support projects that make use of jurisdictions which are blacklisted, or that contribute to tax evasion or tax avoidance. This is a very important parenthesis. As far as the union budget is concerned, tax avoidance is not something immoral, it is something illegal. So we go very far and we assess the project one by one up to the ultimate beneficial owner. Now, Joanna mentioned the question of the governance. I share your view that the current governance is suboptimal and that the system lacks transparency. Even though the Commission has mentioned QMV, I don't think this is the art of the problem, because in practice, they are very, actually, I've been here for a year now, so I've attended a number of code of conduct meetings, and I can't think of a single case where a member state would have taken or not taken a decision because of voting modalities. So this question, QMV versus unanimity, is very important for adopting legislation, but for the listing process, de facto, it's very consensual. So usually we get unanimity very easily. But being more transparent, considering the fact that it has extensive implication for the third country concerned, should certainly be on the agenda. We are discussing it with member states. There is still some reluctance, I won't hide, but at least the final decisions are not taken by the Code of Conduct, they are taken by the Council, the ECOFIN Council, and member states agree that when we reach the ECOFIN Council, there should be full transparency of the decision of the Council towards third country, and this is already a very important commitment. I think going forward, it's important to have also more regular exchange with the European Parliament. And in this respect, I would note with great interest that the new permanent subcommittee on tax issue, which has been established for the first time in the autumn, has decided to organize a special session and hearing at the beginning of December on the functioning of the Code of Conduct. And that, in my view, should be followed by some kind of regular exchange with the European Parliament, because the European Parliament is the center of the democratic process at EU level.
Thank you very much, Benjamin. And I think it's now time to move to the second part of our presentation on state aid and tax rulings. And please, you can go to the next slide, which will be introduced by Rita.
Yes, thank you, Luc. Good afternoon from Vienna. It's an honor for me to introduce the topic, which is still one of the hottest topics in EU tax discussions today, state aid and transfer pricing rulings. And as a warm-up, I would like to just recall the state aid criteria, the conditions which a member state measure has to meet in order to be qualified as state aid. The first criterion is that the aid has to be financed by a member state, so it has to be through state resources. That means that a member state has to finance it from its budget. In terms of fiscal state aid, so when an aid is granted through the tax system, that means that the measure has to lead to a loss of tax revenue. And this criterion also includes the requirement that the aid has to be attributable to a member state. And that means that if a selective advantage were to be granted through an EU directive, that could not qualify as state aid because that wouldn't be attributable to a member state. The remaining three conditions, the selective advantage, the influence on intra-EU trade, and the effect on competition. Now, the last two criteria are normally not examined separately by the EU courts. If the courts find a member state measure selective, then normally they automatically assume that they also influence intra-union trade and have an effect on competition. So that leaves us with the most important, the most infamous criterion of fiscal state aid, and that's the selective advantage criterion. Now it looks like that actually it's two criteria, advantage and selectivity. Advantage means that the beneficiary of the measure has to get an economic advantage. So the financial position of the beneficiary has to be improved compared to its competitors. Selectivity, well, that's throughout the decades-old evolving case law of the EU courts. Basically, selectivity boils down to a derogation from the normal application of the tax system, which also needs to involve an unequal treatment of taxpayers which are in an objectively comparable situation. It's also, if we look at the jurisprudence of the EU courts and the Commission notice on state aid, then within selectivity we can distinguish de jure and de facto selectivity. De jure selectivity follows from the law itself, so the provisions of the law set out a derogation from the generally applicable rules, while de facto selectivity follows from the application of the law, where the provisions themselves do not provide for exceptions, but the application of the law results in a certain group of taxpayers being favored compared to others. And here it's also important to mention another category of selectivity, which is the exercise of discretionary powers by the tax authorities. And this is going to be very important for our later discussion on the General Court's judgments on the Apple case. And that's why I would like to recall the Court of Justice case law on this aspect. So this case law says that if the tax authorities exercise broad discretionary powers, and that means that they can choose the beneficiaries of a measure or the conditions under which a benefit is granted, and such discretionary power is not constrained by objective criteria which are laid down in the law, then such exercise of discretionary power can itself be selective. And now the question is, why do we have these two conditions, these two criteria of state aid together, selective advantage? Because in the recent case law and the recent Commission practice, these two criteria are normally examined together. So the Commission decisions are talking about selective advantage and are examining the presence of selective advantage in case of almost all the tax rulings that we are talking about. And that has been approved now by the General Court in the Apple case. The General Court said that the two conditions can be examined jointly. However, it also added that apart from that, the Commission has to prove both the presence of an advantage and that of selectivity. And that was, again, very important in the judgment, as we will discuss it later on, because the Commission mainly failed in the Apple case because it couldn't prove the presence separately of an advantage that was confirmed by the ruling at issue. So it seems to me that this statement by the General Court in the Apple case that the two conditions can be examined together is rather a formal one, because at the end, both the presence of advantage and selectivity needs to be proven. And finally, until these cases, these transfer pricing ruling cases came to the General Court, it was also a question whether the Commission has competence to review transfer pricing rulings, individual rulings under the state aid rules. But now in each and every judgment of the General Court confirmed that yes, the Commission does have such competence. And we can go to the next slide, please.
Okay, I will quickly jump in on selectivity. As Rita already explained, that the advantage has to be selective, or other way around, we need a selective advantage. So these two criteria are intertangled. However, very often the main difficulty to identify fiscal aid is to distinguish subsidies from other rules of the tax system that have a tax reducing effect, such as the reduction of expenses, or as in the Apple case, the territorial attribution of profits. But as Rita already explained, really in the Apple case, the interesting aspect is this interconnection between selectivity and the advantage. However, in permanent case law, the court works with a three-step approach. So first, we need to determine the reference system, which, due to the member states' remaining tax sovereignty, may not be determined by a comparison to international standards. So the question is not what is usual internationally, but only by an analysis of the tax system of the member state in question. And then we need a deviation, as Rita said, which leads us to the selective advantage. And in rare cases, justification is possible out of the reference system itself. Rita also already mentioned that when we are assessing selectivity, we need to make a distinction between general aid schemes and individual aid schemes, or aid measures, sorry. And with regard to individual aid measures, usually the identification of the economic advantage is, at least in principle, sufficient to support the presumption that it is selective. But that was the problem in Apple, to identify the advantage. However, also Rita mentioned that the problem of tax rulings is that they involve a discretionary power. And this goes often beyond the simple application of the reference system and is deviating from it in favor of the taxpayer. And to make that clear, it's not the ruling as such which is considered to constitute state aid. Even so, it provides the taxpayer with the advantage of legal certainty. The all decisive is its content. And to be able to control this discretionary decision of the member state, the Commission in its 2016 communication on state aid required first that the administrative ruling practice is transparent, and secondly, that rulings are published, because otherwise it is not really possible to test whether we have a selective advantage. And with that, I think I can give to Luke.
Thank you. Can you take the next slide, please? Before looking at the decision of the General Court in the ruling cases, I think it's useful to have a look at the Commission's notice on state aid, to which Johanna just referred, in which the Commission expressed its position under what conditions ruling confer or do not confer state aid. I summarize the most salient points of that notice. The arm's length principle which the Commission applies, and I come back to that expression which the Commission applies in a second, that arm's length principle prohibits unequal treatment of undertakings that are factually and legally in the same position. The ordinary corporate income tax system is the reference framework against which the outcome of the rulings is to be tested. Next point is that under that ordinary corporate income tax system, group companies and non-integrated companies are in the same position, and both should pay tax on profits which stem from prices charged under conditions of free competition. The arm's length principle which the Commission applies is part and parcel of the state aid review. According to the Commission, it can apply independently of whether member states have incorporated an arm's length principle in national legislation and in what form. APAs should apply a methodology which guarantees a result that is a reliable approximation of a market-based outcome. If that is not the case, the APA favors companies belonging to multinational groups and hence confers a selective advantage and state aid to that group company. Although the OECD transfer pricing guidelines are not binding, the Commission may take, for the state aid review, the OECD transfer pricing guidelines into consideration because they are the expression of international consensus within the OECD. And the Commission adds that if an APA complies with the transfer pricing guidelines, it is unlikely that it confers state aid. One, of course, wonders which are the unlikely situations where state aid is conferred and where the transfer pricing guidelines have been correctly applied. And please take the next slide, which is back to Rita.
This slide shows an overview of the currently pending cases on transfer pricing. And it, first of all, it makes a distinction between the categories that Johanna mentioned already, individual aid and aid schemes. And as you see, the majority of the cases are concerning individual aid. There are a few cases which also involve the aid schemes. So when the beneficiaries can be numerous as long as they meet the conditions for the measure. And here we have the Belgian excess profit case. This is what you see on the top of the slide. The first symbol is indicating the Belgian excess profit ruling case. Then we have Engie and Huhtamäki. Now here also it's especially with regard to the Belgian excess profit ruling case, it's actually a contentious issue whether it's an aid scheme or it rather involves individual state aids. There is a disagreement between the Commission and the General Court on this point, and the General Court annulled the Commission decision precisely because of this. The Commission said it's an aid scheme, while the General Court said the Commission should have investigated the individual transfer pricing rulings issued under this scheme. As regards the status of the cases, in most of the cases, the Commission has already brought a decision. The only ones which are still pending, so where there is no final Commission decision, are the Nike, Inter-IKEA, and the Huhtamäki cases. In most of the cases, the Commission found state aid, so that means a negative Commission decision. The exception is McDonald's, where the final decision of the Commission was that the qualification mismatch at issue did not qualify as state aid at the end. And these negative Commission decisions in the other cases, they were appealed. So they are now pending before the General Court or the Court of Justice. The General Court already decided the Belgian excess profit ruling case, Starbucks, Fiat, and Apple. And interestingly, in most of these cases, the Commission has lost. The Commission decided to appeal to the Court of Justice in two cases. In the Apple case, of course, that is, I guess, very well known, and also in the Belgian excess profit ruling case. In the Fiat case, the taxpayer lost and also appealed to the Court of Justice. So right now, the situation is that there are three cases pending before the Court of Justice, two cases before the General Court, and three cases are still pending before the Commission. And finally, the slide also makes distinction between the cases on the basis that on which ground the Commission argued that the ruling at issue deviates from the arm's length principle. And in some cases, as you see, the Commission challenged the chosen transfer pricing method. And that's why the Commission found stated. In other cases, the Commission accepted the chosen TP method, but it said that it was applied incorrectly. So it identified various methodological mistakes in the rulings. And in the third category of cases, the Commission says that a sort of qualification mismatch leads to state aid being granted. And we can go to the next slide, please. And here we have the facts of the Apple case, which I guess is pretty much known to most of the audience, but still it's good to recall the facts in order to prepare the discussion. So the Apple case involved two transfer pricing rulings, which were issued by the Irish tax authorities to two subsidiaries of the Apple Group, to Apple Sales International and Apple Operation Europe. These rulings were issued in 1991 and 2007. And these two companies, as I said, were part of the Apple Group, which is, of course, headquartered in the United States in California. Basically, the rulings were about the profit attribution to the Irish branches of these companies. These two companies were incorporated in Ireland. However, they were managed from somewhere else. That means that according to the Irish tax law, which was in force at the time, the two companies were not tax resident in Ireland. It's not entirely clear from the facts of the case where the two companies were managed from. The Commission talks about a non-existent head office in its decision. It seems most probably the companies were managed from the United States by directors who were resident in the United States. However, the United States also did not consider these two companies resident for tax purposes there. So that means that the two companies were basically stateless. They were so-called nowhere companies. They were not resident anywhere. However, they had branches, as I already mentioned, they had branches in Ireland, which did exist, physically exist in Ireland. They had premises there, employees there, quite many assets, equipment, and they did exercise functions in Ireland. Apple Sales International was in charge of the sales and distribution of Apple products in the region, which basically encompassed the whole world outside North and South America. And Apple Operation Europe, the other company, was in charge of manufacturing a certain specific line of Apple products. The two companies entered into a cost-sharing agreement with their US parent, and under this agreement, they contributed to the costs of developing the technology which was used in the Apple products. And in return, the US parent company, Apple Incorporated, gave the two subsidiaries the right to exploit the IP rights, which are necessary for the sale and manufacture of the products for which they were charged. They were in charge. As the facts show, at the end, the two companies were in charge of all the sales outside the United States, so all the global sales. And the absolute fundamental question, the underlying fundamental question of the case is that the profits of the Apple Group, which are realized from all these global sales outside the Americas, how much of these profits can be attributed to the Irish branches. And for this purpose, the Irish tax authorities issued the rulings which are at issue in this case, and which approved a certain calculation of these profits attributable to the Irish branches. The method approved in the ruling resembled to the TNMM method. And as a result of applying such method, just a very small portion of the global non-American profits of the Apple Group were attributable to the Irish branches. And all the rest of those profits, those non-American profits, basically were taxed nowhere, because the two companies were not resident anywhere, so there was no other jurisdiction which would have claimed taxing rights as a residence country here. And that allocation was challenged by the Commission decision. That's basically the point of the Commission decision. The Commission argues that contrary to the ruling, basically the whole global profits of the whole global non-American profits of the Apple Group should be attributed to the Irish branches. And there, the main line of reasoning of the Commission is that basically in this cost contribution agreement, the IP licenses were transferred to these two subsidiaries, to these two companies, which only exist in terms of physical presence in Ireland in the form of the Irish branches. So it's logical that we can only attribute these IP licenses to the Irish branches, which means that also all the profits which are derived through these Irish IP licenses should be attributed to the branches. And the Commission says that because the ruling approved another attribution, that is basically a deviation from a market-based outcome. It's a deviation from the arm's length principle, which confers a selective advantage on the two Apple subsidiaries. And as a result, the Commission ordered a recovery of state aid, and that's also probably also very much known that this was a record-breaking recovery. It was for 13 billion euro plus interest. So basically, those are the facts of the case. And as you see, it seems to the dispute seems to boil down to the question that the profits of the Apple Group, which were not taxed anywhere, so this so-called stateless income or ocean profits, could these profits be made taxable in the European Union by using the state aid rules, basically? And we can go to the next slide.
Well, as Rita already explained, the Commission always first has to identify the reference system, then it challenges or it questions whether the transfer pricing method is correct, and then the application of this method is has to be tested. And well, Rita already said that the Commission lost because the General Court challenged the transfer pricing analysis of the Commission, and it did it in a very thorough way. So, but first, before we can really question this application of the transfer pricing rules, the General Court had to identify the reference system, and basically said that the Irish corporate income tax system, meaning the ordinary rules of taxation of corporate profits in Ireland, consequently also this reference system also included the provisions applicable to non-resident companies. So this was the reference system. In the second step, the court asked whether the Commission was entitled to use the arm's length principle to analyze the allocation of profits to the Irish branches. And it came to the conclusion that the Irish national tax system first makes no distinctions between integrated undertakings and standalone undertakings. So branches of non-resident companies can be compared to standalone resident companies. And with this, the court said, well, in both cases, according to the Irish reference system, the attribution of profits is based on market prices. So basically, this was confirming that the arm's length standard has to be applied out of the reference system of Ireland. Next slide, please.
The court then went on saying that the arm's length principle serves as a tool or benchmark for determining whether the level of profit attributable to the Irish branches approximates the profits of non-integrated companies resident of Ireland and subject to tax there. And then the court made a very, very important precision to its decision. It said that in order to use the arm's length principle as a benchmark, that arm's length principle should be part of the national law of the member state concerned. So here the court does not endorse the EC's notice on state aid, where it is said that the arm's length principle is something which is inherent in Article 107 of the TFEU. Ireland and Apple argued that the arm's length principle was not formally incorporated in the Irish tax code, and thus that the Commission could not make use of it. But that argument did not impress the court. The court refers to a standing practice of the Irish authorities of determining the profits of Irish branches of non-resident companies by some method that comes very close to the separate entity approach and the two-step analysis for attributing profits to PEs set out in the OECD guidelines. That is, treating the branch as being an entity independent of the rest of the enterprise, and then performing a functional and factual analysis, and then after that, determining the market value of the activities actually performed by the branch. And the court points to Irish High Court case law that confirms the practice of the Irish tax authorities. So this is, in my view, a very important part of the decision. Use should be made of the arm's length principle embedded in national law. There's no requirement that such embedment is taking place in a formal way. It can be shown by administrative practice by tax authorities, provided there is clear evidence in the practice and the case law of that member state. And that then raises the other question, which is on the slide: what if no arm's length principle is incorporated in domestic tax law?
As Luke already explained, in the Apple case, this didn't matter really, because the General Court basically stated that the arm's length principle was part of the Irish tax system. So it's really the question, I mean, if a country, member state, has no arm's length principle in its tax system, I think this is a usual case, then the question arises whether the arm's length standard and the OECD guidelines can also be applied just for purposes of Article 107, even if it is not part of the domestic tax system. And the General Court stated then, I think this is a very important statement, that there is no freestanding obligation to apply the arm's length principle arising from Article 107 TFEU, which would oblige member states to apply that principle in their national tax law. So this is not a freestanding principle. And of course, I mean, in the absence of EU rules governing this matter, it falls still in the competence of the member states to designate the basis of assessment for the taxes. So the General Court was careful not to question the primacy of domestic law. Next slide, please.
Yes, and in this respect, in the question of national versus OECD approach, the General Court stated that since Irish domestic law provided that the profits derived by non-residents through an Irish branch have to be determined by taking into account the market value of the activities of the Irish branches, that approach is basically, in a sense, equals to the arm's length principle as it is laid down in the OECD transfer pricing guidelines. So what we see here is basically that the non-binding OECD transfer pricing guidelines become benchmark in EU's stated review if there is some sort of overlap with the domestic arm's length principle. Now, the Commission used not only the arm's length principle, but also the authorized OECD approach to attributing profits to permanent establishments as a benchmark to review the Irish tax authorities' ruling at issue. And the General Court agreed with the Commission use of the AOA as a benchmark. And it said that on the one hand, the AOA reflects an international consensus on the issue of attributing profits to permanent establishments. And on the other hand, the Irish domestic law basically follows the AOA approach because it also requires to take into account the objective facts of the Irish branch, meaning that the activities exercised by the branch and the assets and risks assumed by the Irish branch. And then it also requires to determine the value of the activities of the Irish branch on the market. So basically this boils down to the same approach as the AOA.
And I think this is the important part that the General Court stated, that there are enough overlaps of the Irish domestic law with the functional and factual analysis proposed by the AOA. I had a little bit more problems with the statement that the AOA is an international standard. Of course, it is an OECD model convention standard. However, I don't think that the assumption that the AOA is an integrated part of the tax law of all OECD member states is correct. So I think if you would consider this correct, then we would give the OECD model convention a harmonizing effect that it does not deserve. So in Germany, for example, where the attribution of profits between headquarters and branches in the past was based on the indirect method, the legislator saw a need to introduce the AOA formally into the German Foreign Tax Act in order to provide a sufficient legal basis to follow the AOA, also in cases where the AOA is not content of the double tax treaty, thus especially for double tax treaties concluded before 2010. So what was decisive in the Apple case was a statement that the Irish reference system is close enough to the AOA that the AOA can be applied. Next slide, please.
On the burden of proof, the rules are of course very clear and the court confirms these rules. The burden of proving that a ruling confers a selective advantage to a taxpayer rests on the Commission, that has to prove that either an incorrect transfer pricing method is applied or the correct method was incorrectly applied, as was shown on one of the previous slides. Here in the Apple case, the Commission used what the court calls an exclusion approach. According to the Commission, the Apple licenses, the Apple IP licenses, and the profits derived therefrom had to be attributed to the Irish branches by default, because they could not be allocated to other parts of the company, as those other parts had no assets and no personnel to carry out these functions. And the Commission thereby disregarded the critical functions in connection with the IP that have been carried out by the Apple companies in the United States. That approach, in practice, discharges the Commission from proving in a positive manner which were the functions, assets and risks of the Irish permanent establishment. And in particular, I think the Commission failed to prove that the Irish branches controlled the IP licenses. And that seemed to be very critical under Irish law and the case law referred to, the Irish case law referred to by the General Court. So the General Court dismissed the method used by the Commission as not being in line with the separate entity approach. It was a mere presumption based on the unproven argument that the functions regarding this IP were performed nowhere in the group. The court deplores that the rulings have been issued without the Irish tax authorities having access to proper transfer pricing documentation. But at the same time, the court ruled that such does not discharge, such methodologic defects do not discharge the Commission from its burden to prove that the rulings conferred an advantage on the Apple companies. And as I said, the Commission applied a methodology, the Commission itself applied a methodology which was at odds with the arm's length principle. And the Commission, as Rita already explained, went very deeply in challenging the application by the Irish tax authorities of the transactional net margin method. According to the Commission, that method was wrongly applied on various grounds: incorrect identification of the tested party, incorrect selection of the profit indicator, incorrect selection of the level of return. The court rebutted all these arguments in not less than 166 paragraphs. So therefore, I think you should agree that methodological defects in the case at hand were insufficient to prove an advantage. And I think one should also agree with the court that the absence of transfer pricing documentation does not in itself prove that the Irish tax authorities used broad discretion when issuing the rulings. The tax authorities, as in my view, convincingly established by Apple and Ireland, the Irish tax authorities correctly applied the two-step approach under the separate entity method, which included an objective, not a subjective, an objective analysis of the functions, assets, and risk of the branches. But I'm pretty sure that not all my panel members will agree with me. So please feel free to intervene.
Yes, if you allow me, Luke, sure. I would respectfully disagree with you and the General Court as well, basically on all these points, which I think are pretty much interrelated. First, I would like to emphasize that how high the burden of proof was that the General Court imposed on the Commission. While, on the other hand, the taxpayer and the Irish tax authorities got away with not being able to produce any sort of contemporaneous TP documentation or TP report which would have substantiated the amount of tax liability which was endorsed by the ruling. To me, it seems that basically the process of issuing this ruling was that the tax advisors of Apple met with the Irish tax authorities. They agreed on a figure, on a certain amount of tax liability, which was acceptable for both. The tax authorities issued a ruling on it, and then later on, the taxpayer produced a sort of ex post facto TP documentation, which was used to justify the amount of tax liability which was endorsed by the ruling. And this was completely known to the General Court. The General Court was fully aware of this and made several critical remarks on this process in the judgment. However, at the end, the General Court considered that these were merely procedural or methodological defects in the application of the Irish law, which neither conferred an advantage on the two Apple subsidiaries, nor amounted to discretionary practice by the tax authority. And that to me is a pretty peculiar assessment of discretionary practice, because at the end, the issuance of the ruling was completely arbitrary. It was basically a negotiated tax liability, which was approved by the ruling. And here the Commission referred to discretionary practice, that such broad discretion in itself should be considered selective. And the General Court, as you said, Luc, rejected that argument. And it rejected that argument by referring to the Court of Justice case law that I referred in the beginning of this section. The General Court said that basically here there are objective and consistently applied criteria according to which you have to apply Irish law on attributing profits to branches. And that is, if that is the case, then there is no discretionary practice. However, I really want to emphasize here that that case law was on 8 schemes. And here we are talking about an individual aid, an individual transfer pricing ruling. And I think the test of discretionary practice cannot be the same in the two cases. Here we have we clearly know the circumstances, how this ruling was issued without any prior documentation being submitted to the tax authorities. So it really seems to be arbitrary. And even if there are objective and consistent criteria to apply the Irish law at issue, in the absence of any documentation or evidence, we don't know if and how the Irish tax authorities applied those objective criteria. And that, to me, it seems that can easily amount to arbitrary exercise of discretion, which is in itself selective.
I would agree with Rita that this could be a point where the Court of Justice could deviate from the General Court's decision, because I mean, if you try to assume, to make a prognosis how this General Court decision will be assessed by the Court of Justice, then one question could be, will the actual transfer pricing analysis will be challenged, or even if the Court of Justice doesn't go as deeply as the General Court into this transfer pricing analysis, it could, I agree, it could say, well, but this was a very intransparent procedure, and it's hard to understand how the Irish tax administration came to this result, even if the result might be correct. But I think transparency is a condition of itself to have a allowed state aid. So there could be also another way to question the outcome of the General Court. And this is if we do not apply a unilateral approach, but an overall approach. Because, I mean, maybe that's the fundamental essence of the Apple case. The Irish transfer pricing ruling policy would not have raised the same concerns if the profits not attributed to Ireland would have been taxed somewhere else, maybe at an even higher rate than the Irish 12.5%. But as Rita already explained, this didn't happen. So in the end, there is no doubt that Apple overall enjoyed a very favorable treatment. And the choice of Ireland for its global activities was not by accident. However, as I said, the reason was maybe not, or at least not only, the Irish transfer pricing practice, but the Irish former residency rules, which led to stateless income. So the General Court didn't really discuss this because the Commission's decision was not based on this aspect. The crucial question is whether it could have been based on the Irish residency rules and whether state aid is the right instrument to tackle double non-taxation. Well, there's this citation of Nellie Crow's statement where in 2014 already she said, well, state aid is not the right instrument to go after double non-taxation. And indeed, often in hybrid mismatch cases, it is difficult or even impossible to decide which state is to blame for the low taxation or the double non-taxation if both states apply their normal tax system. And we understand tax subsidies as a deliberate promotion of a certain economic activity and not as something what happens due to the coexistence of non-harmonized tax systems. However, there is, in my view, a little difference to normal hybrid mismatch cases, normal double non-taxation cases, and that is that the Irish residency rules caused under taxation in a foreseeable manner. And therefore, one feels reminded of the Gibraltar corporate tax system case, where Gibraltar basically planned to implement a general tax system for corporates, applying to all corporates residing in Gibraltar. But by the design of the tax base of this corporate income tax, it led to a highly beneficial treatment, in particular for holdings of big foreign multinationals. So also there, it was the normal tax system, but designed in a way that indirectly it was selective towards this big holding companies. And their selectivity was confirmed. So I do think that here, I mean, maybe the statelessness of the income is a real problem. Next slide, please.
Yes, we can move to the next slide. We have 30 minutes to go. This slide deals with a slightly different subject. It's related to state aid, and it's related to foreign subsidies. I mean, subsidies granted by third countries directly or indirectly to European-based companies. And we want to draw your attention on the white paper on foreign subsidies, which was issued as a draft in June of this year by the Director General on Trade of the European Commission. And Rita will briefly introduce that to you, but let's do that in a rather limited fashion so that we have at least 25 minutes to discuss the digitalized economy after that topic.
Yes, so this is a very interesting legislative initiative by the Commission. This white paper was issued earlier this year on the 17th of June, and basically it started a public discussion on a possible future legislative proposal to be submitted by the Commission on foreign subsidies. And that would mean aid which is granted by non-EU states. The underlying problem is that this proposal would basically remedy that the EU state aid rules, of course, apply only to aid granted by member states. And there are no such strict state aid control regimes in the main competitors of the EU, in the big economies competing with the EU, which means that they can rather freely subsidize their own companies. And that leads to problems of level playing field between EU companies and non-EU companies. And basically here the Commission is setting out something which would extend effectively the state aid regime to non-EU states. So we could even say that it tries to give some kind of extraterritorial effect to the EU state aid rules. It defines foreign subsidy very broadly, basically a financial contribution granted by a non-EU government, which confers a benefit on an economic player that is active also in the EU market. And that would, of course, cover also any kind of tax benefits. So we don't know yet what exactly the Commission has in mind to put forward, but it could have any kind of legislation that is adopted later could have the effect that basically if there is a multinational group where the parent company is resident in a non-EU state and it enjoys some kind of preferential tax regime or is not taxed on income on which it should be taxed, and it has a distortive effect on the EU market, then the EU affiliate of the group could be taxed on the income which was not taxed in the hands of the parent company. So this could be some kind of tool which could be used in an Apple situation, where basically the problem was caused by double non-taxation, and specifically that the non-EU country, the United States, did not tax the income which it should have taxed. So this is the relevance, or this is the connection why we thought that it's interesting to mention that as a potential new tool in the future, this foreign subsidy legislation.
Thank you, Rita. Bob, this could be of interest to US companies, of course, and we would like to hear your views on this white paper.
Yeah, sure. I mean, I tend to think of subsidies as generally the subject of lots of different trade agreements around the world. But to the extent this could be applied in the tax context, I would simply pose the question of how such rules could intersect with the desired goals of the G20 to improve tax certainty around the world, which in the view of the G20 is necessary to create global growth. And I think if just today's discussion should underscore that the application of these state aid rules in tax cases is far from certain. So I think I would view it mostly in that context. Obviously, there's the extraterritorial point as well that Rita mentioned, but there is potential here for adding a high degree of uncertainty if these rules moved out of the trade space and also back into tax.
Thank you, Bob. We will now move to the next slide and our first poll question. I will briefly summarize the question to you and the potential answers. So, do you think that the Apple case will be reversed on appeal? Answer A is yes, because in its decision, the Commission has proven that too little profit had been allocated to the Irish branches. Answer B says yes, because the rulings are discretionary, as the Irish tax authorities decided without proper TP documentation, and answer C is no. So please cast your votes. In the meantime, we may already move to the next question while we're waiting for the answers to appear on the screen. Oh, here are the answers. And it looks as if there is a slight majority voting that the Commission will lose the appeal. We have 52% saying no on the question whether the case will be reversed on appeal. Thank you very much. And we move to the next poll question. What would be the best instrument to achieve an internal market without disparities? A, state aid. B, harmonization by legislation. C, coordination without adopting hard law as the soft law option, or D, the EU should not act. While we're waiting for the outcome, we can move to the next slide. Thank you. Harmonization by legislation has a large majority vote of 71%. Thank you very much. And now we move to the last part of the presentation, EU and digitalized economy. Bob, the first slide is yours.
Thank you so much, Luc. So here, this is just a little bit of a slide about how we got where we are today. As we all know, blueprints were issued on Pillars 1 and 2 on October 12th. But how did the journey proceed? Well, BEPS Action 1 targeted the digital economy. It set up a digital task force, which I co-chaired with my then French counterpart. And it did three things that kind of set the table. First, it did very important work on the improvement of VAT with respect to the collection of VAT on digital goods and services, which has been actually copied and implemented in many places. Second, it set out some options that countries could do if they did so consistent with their international obligations, but it didn't endorse any particular options. But finally, and perhaps most important, I think in the work we had done in that task force, we realized it was very difficult, if not impossible, to ring fence the digital economy. In fact, that was one of the big conclusions. You cannot ring fence the digital economy. That was not really a political statement. That was really the practical recognition that while many people think you can identify the digital economy because it's the big tech companies, in fact, digitalization is happening everywhere, and the lines between a digital company and a brick and mortar company are perhaps, hopelessly blurred. Now, that particular outcome of the digital task force didn't satisfy some countries who really wanted there to be, let's say, a firmer solution to the income taxation of digital companies, perhaps something like a digital permanent establishment or what. So in 2017, when Germany had the presidency of the G20, Finance Minister Schäuble saw to it that the digital economy issues stayed in the G20 communiques. And that led to, the way I think about it is the work kind of bifurcated in two places. First, the OECD stayed at it, and that culminated in the documents that just came out. But the EU, as Monsieur Angel will speak more about, also proposed a directive that had two components. First, an interim measure, what became known as these gross-based digital service taxes, and also a longer-term significant digital presence approach. The importance to the work, though, was that then with these interim measures and the possibility of broader unilateral measures around the world on this issue, I think increased the appetite of companies and countries to come to the table at the OECD and increase the search for a multilateral solution to the taxation of the digital economy. That led us to the OECD Unified Framework. And here, how we got there, just a brief note. So as we moved to continue to do more work on the digital economy, there were still many countries that were of the view that this whole issue of digitalization is about the unique features that they identified as associated with the digital economy: user input, data, active engagement of the people in the market in the creation of value. But the US position, while they were willing to be at the table to come up to a global solution, was still not willing to have a solution that basically aimed at one sector that the US tended to take the lead in, namely the tech sector. And so the US brought to the table the notion that if we're talking about value added in the market through users or data or active engagement, we're probably really talking about a broader issue of marketing intangibles because of the fact that the markets may not be reaping sufficient benefit from intangible values linked to their market. And that led to the idea that the work should focus not solely on digital companies, but also on consumer-facing businesses. And now, in addition to changing the scope in that respect, the companies of a broader range of countries might be in the mix for the work on Pillar 1. Well, that led some countries to think, well, actually, BEPS did not really have anything to do with marketing intangibles or reallocating profits to market jurisdictions. BEPS was about being sure that companies paid enough tax. And that's what led to Pillar 2. Pillar 2 is about being sure companies pay a minimum tax with an undertax payment rule to police it, and a separate concept of a subject to tax rule to be embedded in treaties. And those two together were those two then wound up not as separate prongs or battling it out so one would proceed and not the other, but both prongs proceeded in the political space. And that is where we are today with Pillar 1 and Pillar 2, two very different approaches, but both at the center of the search for a political agreement. And with that, I'll go back to you, Luke, because I think we have a poll. You're on mute, Luke.
We cannot hear you, Luke.
I'm sorry. The question is whether the inclusive framework will find a solution in the course of next year for the pillars 1 and 2, and the potential answers are yes for both pillars, B, yes only for pillar 1, C, yes only for pillar 2, and D, no solution will be found. We are anxiously waiting for your votes. And you're looking very skeptically towards the future. 50% of our audience believes that the OECD will not come to a satisfactory solution on Pillar 1 and Pillar 2 next year. That is, of course, to be seen next year. We move to the next slide, and this slide will be handled by Benjamin.
Thank you, Luc. Bob has already said a few words about our initial proposal in 2018. I won't dive into the detail, but I guess the key element was the one he highlighted. The primary purpose of this proposal was to help bringing people at the negotiating table. And it was essential, particularly to pass a message to the giant of the digital sector that the alternative to the OECD process was not absence of taxation, but rather a multiplication of different measures of taxation around the world. It has not been adopted, as you know, but it has been used as a source of inspiration by a number of member states. So today, some of them have a DST in place. This is the case of France, of Italy, of Austria, of Spain recently. Czech Republic is also discussing it. But I guess it's fair to say that the European have just initiated a movement, which is a global movement with a number of countries having adopted temporary measure for the same purpose, which is putting pressure on the United States and on the American company to join the process. We have DSTs today in country, or either adopted or about to be adopted in countries as varied as India, Indonesia, Brazil, Turkey, Kenya. So it's really a global phenomenon. And it has achieved its purpose of changing the line and message coming from the main player of the digital sector. If you look at the submission of Silicon 100, which is the association gathering the main players from the digital sector in the US, to the Section 301 trade procedure initiated by a trade representative like Lighthizer, they support the OECD process. And they support the OECD process not out of sheer love for the idea of having this agreement, but rather because the counterfactual for them is worse. Can we go to the next slide, please? So if we go pillar per pillar, where do we stand today and what is the situation for the EU? On pillar one, Bob mentioned that there, after a discussion which started initially on digital, there has been a push towards a broader scope that is called the consumer-facing businesses. This push was primarily initiated by the United States, which I guess hope that this would make the whole process less palatable to the European. It slowed down quite significantly this year. This was for two reasons. First, because the United States themselves started to have second thought on whether it was such a great idea to extend to consumer-facing businesses. Second, because the European have asked for a staged approach where we start with the digital sector. And when you think about it, I'm convinced that we are not able to move to a broad scope quickly. You have to keep in mind that we are talking of multinational companies which are operating in a very large number of countries. And to be able to run in practice Pillar 1, you need an ex-ante agreement between sometimes 10 to 15 tax administration. If you apply it to companies operating in the digital sector, then you're talking of an agreement to be found for probably a triple-digit number of companies. If you're talking of including consumer-facing businesses, we're talking of 6,000 to 8,000 companies. Imagine what it means to have to find an agreement between 10 to 15 tax administration for 6,000 to 8,000 companies, knowing that the tax administration are extremely diverse. Some are modern and digitalized, some have less, some less so, and have more difficulties to cope with this kind of negotiation. The overall Pillar 1 has been severely affected by the stance of the United States this year. It started in December last year, where Secretary Mnuchin wrote asking for a safe harbor, which is some kind of optionality. That is, the United States have been pushing for companies to have the possibility to choose between being under the OECD system or out. The United States have never fully clarified what the safe harbor mean, and there's notably a key question which they have never answered. And this question is, what would happen for the companies that would not opt in? Would that mean that countries could still tax these companies via DST? That is a very fundamental question, and we never, ever had the answer. And not only has the United States refrained from answering these questions, they have gone aggressively via trade procedure against all countries having introduced DSTs, and even against countries which are just discussing about the possibilities of introducing a DST, which is a rather weird way of using trade procedure. We still have today a high number of elements which are not agreed on. So there is no agreement on whether to start as a first stage with the digital sector only. There is no agreement on whether to have a safe harbor or not. And there is no agreement on a very difficult topic that Bob has mentioned in his introduction, which is segmentation. Do we apply the system to a company as a whole, or do we try to segment the digital part of possibly brick and mortar company? The second is much more accurate, but it's also far more complex, as you can imagine, if you have to start cutting in pieces a company. The OECD, confirmed recently by the G20 over the weekend, have set a new target of mid-2021. Clearly, it was not possible to meet the previous target for a number of reasons. This new target remains challenging. As far as the European Union is concerned, there is somehow an element to keep in mind, because this element has a calendar of its own. For the own resources, the decision that is to be taken on the future resources of the European Union, the agreement between Council, Parliament, and Commission is that the Commission should make a proposal on a digital levy by June 2021. To make a proposal on the digital levy by June 2021, we need a text relatively stable by spring. And by spring, it is rather unlikely that we have full clarity on the OECD process. So we're not even talking of a plan B at this stage, because for sure there will be a proposal for some form of digital taxation in Europe to finance the union budget coming in June. What we are trying to do is to build this proposal so that it is OECD compatible. So as that does not undermine any possible development in the OECD and any possible delay, because even though we have been saying that we don't want 2021 to be some kind of moving target, this mid-2021, we don't know at what rhythm the new Biden administration will take office. And whether they control the Senate or not will also be a very important thing to keep in mind, not only for the rhythm of the nomination, since they need to be vetted by the Senate, but also because any agreement on Pillar 1 would be a multilateral convention, and as a multilateral convention, it would need to be ratified by the Senate. So whether Joe Biden has a friendly Senate or not will also impact on the capacity of a Biden administration to possibly shift the trajectory. The truth is that we don't know what the Biden administration will say on digital, but so far there is some kind of positive wait and see, since we expect at least a new administration to be more open to multilateral discussion and multilateral processes. Next slide, please. Pillar 2, as Bob has said, is very much a leftover of BEPS. It's a fundamental reform in essence. It has more or less the same deadline as Pillar 1, though it is in essence disconnected from the context of Pillar 1, because this has absolutely nothing to do with Pillar 1. It has been politically connected. It has been politically connected by many players for sometimes different reasons. But for us Europeans, the main reason why it is connected is that we care a lot for both. And there is a big difficulty in getting a support from the United States on Pillar 1. And this difficulty is self-evident. There is no scenario where Pillar 1 would not translate into a reduction of the taxable base for the United States. So if we want to have the US to agreeing to Pillar 1, we need to come up with something which is palatable for them in the same package. And Pillar 2 can very well be this something. Because today, the United States have, as you know, a system of minimum taxation in place. They are one of the only countries in the world to have it, with GILTI and BEAT. And this system creates a de facto comparative disadvantage for the United States. If you're a multinational and you hesitate between locating in the US or locating, I don't know, in Ireland or wherever, you know that if you go to the US, you will have this minimum taxation that will apply to your sub all over the world. If you go in Ireland, that's not the case. If you have a Pillar 2 agreement, somehow this comparative disadvantage for the United States disappears, especially since the OECD has shown willingness so far to go for some kind of broad equivalence between GLOBE, the OECD name of Pillar 2, and GILTI. This interest could even increase if Biden administration manages to implement a promise of Joe Biden during his campaign to bring guilty at 21%. With a 21% rate, it would become pretty critical for the United States to have a global agreement on Pillar 2. So we want our best to have a package on both. The discussion has been difficult this year with some developing countries and with China. Some creative solution has been found with formula carve-out. But we are very close from a situation where an agreement could be found, but provided it goes end in end with Pillar 1. And that is obviously a key question. As far as the EU is concerned, if there is no agreement in the OECD, then there is less pressure from the calendar, because for digital, we have this pressure of June where we have to come up no matter what with a legislative proposal. For Pillar 2, we could at least theoretically afford to take a bit more time, though it depends obviously on President von der Leyen and Commissioner Gentiloni to decide on how much time they want to wait. We still hope that there is an agreement found by June. And if there is no agreement, if the negotiation failed, we will table our own EU proposal that we will apply unilaterally, a bit like the United States did. But that just shows that we care a lot for both pillars, and we hope that the OECD will succeed on both fronts. Thank you.
Thank you, Benjamin. We then move to the last slide of our presentation. And I think I should give the screen here to Bob to make some observations generally on this slide. We are almost at the end of our presentation, so I would call it the closing observation from Bob. Then we move to the poll question on the next slide. And after that, I will give briefly the floor to Rita to answer one of the many interesting questions that were raised to her. So Bob first.
Thank you. And thank you, Luc. And I just wanted to emphasize quickly, perhaps 3 points. First, I agree with Monsieur Angel that it's rather unlikely that the OECD process will hit the new mid-21 deadline, or as he mentioned, spring, so that the EU needs to take a determination. And there are 2 reasons for that. Michel Angel mentioned the Biden transition, which is absolutely true, but he also emphasized that there's really a high number of questions in that document that don't have agreement yet, political agreement, beyond the safe harbor proposal. And if you work through the documents, you can see that there's a major issues left to be decided politically. For example, will developing countries be able to get the subject to tax rule? And if not, for example, would they agree to the rest of the package? Michel Angel also emphasized something that's really important for a global audience to appreciate, and he understands it well. In the US system, the executive can't bind our Congress with respect to new statutes or respect to treaties. And that creates a dynamic for us that is extraordinarily challenging in the US. And finally, I would just mention that, as Michel Angel mentions, the DSTs are on the march. And even if there's a political agreement at the OECD, the implementation of that agreement seems several years off. And so there's a question of whether or not the timing of the whole OECD project is really sufficient to deal with the unilateral measures that are coming now. So I'll leave it there, Luc, in the interest of time.
Thank you very much. Can you please move to the last slide of our presentation, the last poll question actually, which is the following: on the assumption that no consensus will be reached at OECD level on a solution for digitalized economy in 2021, what is the way forward for the EU? A, revamp both or one of the 2018 proposals on the digital economy. B, EU will not obtain unanimity on either of the above, and a patchwork of unilateral DSTs will come into being. C, the EU should not act at all. And as I said, after your answers to this poll question, we immediately move to Rita, who will address one of the questions on state aid that were raised to her by the audience. We have a very split vote here, 40% revamp both proposals 2018 and 45 EU will not obtain unanimity, so we will get a patchwork of unilateral DSTs. Thank you very much for your votes. And now, Rita, the floor is yours once again.
Yes, thank you for the interesting questions. And as Luke told, I only have time to answer one of them, and I apologize to all the other participants to whom I cannot answer. Maybe they can reach out to me by email. I'm always happy to discuss state aid questions. So this question relates to my remark regarding the discretionary practice that I think the Irish tax authorities exercise of issuing this ruling amounted to discretionary practice or arbitrary exercise of discretion, which should be selective in itself. And the question raises the very valid point that what about advantage? Because even if there is selectivity, and even if the ruling can be considered selective, as the General Court emphasized, the presence of advantage also has to be proven. And normally the burden of proof is on the Commission, even in the case of individual tax rulings, to prove that there was an advantage granted by the individual ruling. And here is exactly the point that I didn't have time to fully explain, that I think that the fact that there is selectivity, which this basically this discretionary practice of the tax authorities entail, that should mean, because of this gross procedural and methodological mistakes that were present in the issuance of the tax ruling, which are selective, which entail selectivity themselves. I think the burden of proof should be reversed in this case. It should not be on the Commission. Because of those gross negligence and basically arbitrary exercise of issuance of a ruling, I think the Commission is entitled to assume here that if these IP licenses were transferred in a cost-sharing agreement to the two Apple subsidiaries, and the Apple subsidiaries only exist in terms of physical presence in Ireland, then they should be allocated to Ireland. And it should be up to the taxpayer to prove that no, because functions are exercised somewhere else regarding these IP licenses, risks are assumed somewhere else, and therefore these IP licenses should not be allocated to the Irish branches. And in addition to that, it should also be proven by the taxpayer that where these functions are exercised, because that's the problem here, that we don't know. It seems to be a non-existent head office. And if the taxpayer is not able to prove that, then I would say that the Commission is entitled to maintain its assumption that all the profits which are derived through these IP licenses should be attributed to Ireland. So basically, my opinion is that because of these gross procedural defects and mistakes, which are selective themselves, the burden of proof should be reversed here.
Thank you very much, Rita. This is a novel view, I think, on the who carries the burden of proof in case of state aid. That could be a nice topic for next discussion, maybe next year already, because we go on with IFA-EU, of course, on the next Congress. Ladies and gentlemen, we have reached the end of our presentation today. We wanted to discuss much more with you. We had many other ideas we haven't been able to voice, but unfortunately, we are at the end of the presentation. I need to thank, first of all, the audience for your attendance. I see that you are still many around. Thank you very much for that. And of course, I would like to close this session by thanking the members of my panel for their presentations today and the preparations that they have undertaken to bring it to a nice end here today at this event. So thank you very much, and good afternoon, good evening, good night, wherever you are. Bye-bye. See you next time.
Ladies and gentlemen, first of all, I want to thank the participants, and particularly the panel and its chair, Luc de Broe, who gave us a very interesting afternoon session on EU developments in which IFA is always interested. Thank you for that. As announced earlier, the poster sessions are now accessible for half an hour. Tomorrow, the poster sessions will be open again from 2:30 p.m. till 3 p.m. And after that, we will move to the virtual room of the IFA OECD seminar. That's for tomorrow. For this moment, I wish you a pleasant rest of the day, and till tomorrow.